On September 5th, the U.S. yield curve, as measured by 2-year versus 10-year, traded in positive territory for the first time in over 2 years. Now, the inversion that began in July 2022 was the longest in history. Now, the shift to positive territory, or steepening, occurred in the context of a bear steepener, meaning rates across the curve were all moving higher, but long-end rates were rising faster. Now, several possible reasons were cited for the shift in the yield curve. Some analysts believe that the Fed's easing cycle, which began on September 18th, may have been a bit premature and could lead to a resurgence of inflation. This scenario could force longer-end rates higher while keeping short-term rates lower. Now, U.S. 10-year break-even inflation expectations support this argument, having moved from 2.03 in mid-September to a current level of 2.36. Now, others interpret the move in the long end as an indication of growing confidence in the U.S. economy following promises of tax cuts and deregulation. In this case, the perceived safety of U.S. Treasury bonds would be less attractive if investors feel there are better opportunities elsewhere. Now, the next significant data release is on November 27th with the U.S. GDP and PCE, the Fed's favored inflation measure. Now, the inflation data could affect the shape of the curve in two ways. First, a significantly higher number could eliminate the need for the Fed easing and perhaps flatten the curve. Secondly, a number that is mildly higher or in line with the current higher rate could convince the market that the Fed will remain resolute even at an inflation rate that's higher than their stated target, which could steepen the yield curve. Now, if a trader believes that the yield curve could continue to steepen from here, they could buy the November 2-year versus 10-year Treasury yield spread at positive 12 and target a return to an average level of positive 100. Now, a stop for this trade can be placed below at negative 35. This trade can make $880 if the target is reached and risks $470 if you're stopped out of your level. Now, there's two things to remember about the micro contracts. These are monthly contracts that need to be rolled at the end of the month to keep your position alive, and this trade gives you two separate positions, and the stop level may need to be monitored manually. Now, if a trader believes that the yield curve could return to negative from here, they could sell the November 2-year versus 10-year Treasury yield futures contract at 12 and target a move to the mid-August lows of negative 20. Now, a stop for this trade could be placed above at positive 35. This trade can make $320 if the target is reached and risks $230 if you're stopped out of your level.